Now I think is it okay now? Yeah. Okay.
Can you hear me, Monica? Jimit here. Yeah. Yeah. Thank you.
Good afternoon, everybody. We'll be starting the session very soon. We're just waiting for one of our speakers.
Hello, Monica, Jimit here. You can hear me?
Yes.
Yes, you're audible, Jimit.
Okay. Okay, thank you.
Yeah, hi Jimit. Hi Madhav. Hi Seema.
Hi, let's start the session. We already have 40 participants, Mr. Bakshi, so we can
Okay.
start. Yeah.
So we have all the panelists also, Seema.
So you can maybe start the session while I'll just try and reach out to Mr. Jagannathan. We can start the session, please. Thank you.
Sure. Very good evening to all of you for this exclusive session for ICMA members on Union Budget 2023 to analyze and understand what the budget means to the CE industry. I sincerely thank and welcome the panelists, participants, and the members for joining the session. As we all know, Budget 23 has been presented with 7 priorities, or the much talked about Saptarishis. More than new things, it's more about retaining, maintaining, and stabilizing the initiatives which government has been taking for last few years. And the Saptarishis include inclusive development, reaching the last mile, infrastructure and investment, unleashing the potential, green growth, youth power, and financial sector. The entire budget is structured towards these priorities. CE's industry's growth is directly linked to the growth of infrastructure, and if we go by the sheer numbers, we see a huge potential for the industry to grow. With an unprecedented planned capex outlay of 10 lakh crores, continued focus on roads, railways getting about 2.5 lakh crores, which is the highest ever allocation to it. There are other initiatives like 100 critical transport infrastructure projects which have been identified for implementation for core sectors like coal, ports, fertilizers, and steel. Allocations for Prime Minister Awas Yojana increased by 66% to over about 79,000 crores. Manhole to machine hole mode, all cities and towns will be enabled for about 100% transition of sewers and septic tanks. 50 additional airports, heliports, water aerodromes, and advanced landing grounds will be revived for improving regional air connectivity. 35,000 crore for energy transition to net zero emission goals. So we can go on and on, but it is very important to read the fine print. And some of the questions that come to the mind of any industry persons are like, do we have enough resources to fund these kind of investments? Are the inflation and interest rate hikes behind us? How will the impending global recession will play? How are the supply chain side issues and high input cost, including energy cost behind us? What is the upside potential of the China's relaxation of zero COVID and opening up of the economy, and what it means for us? Can the finances of state governments support the kind of initiatives what you're talking about, etc., etc.? It is thus best left to the experts and industry leaders to help us understand how exactly should we interpret the same. I will just stop here and introduce the esteemed guests and panelists for this session, exclusively designed for the members of ICMA. We have with us Mr. Ashish Modani, Co-Group Head, Corporate Ratings, ICRA. Ashish is currently leading the analytical team in the infrastructure vertical. Over the years, Ashish has worked on credit assessment assignments across various sectors like automobile, agri, engineering, infrastructure, and power sector. He has also worked on development on rating methodologies and credit framework in the automobile and infrastructure. He holds a BTech degree in Electronics and Communication Engineering from the National Institute of Technology, Calicut, and MBA from Narsi Monji Institute of Management Studies, Mumbai. Ashish has an aggregate work ex about 15 years, and he has been associated with ICRA for about 12 years. So Ashish will be decoding the budget for us and how does it affect the industry. I also welcome Mr. Jimit Devani. Jimit is a partner with Deloitte India Tax, handling direct tax and international tax. Jimit is currently the Energy Resources and Industrial Tax Leader of Deloitte India. He has more than 20 years of tax and regulatory experience. His experience encompasses broad range of industries, which include infrastructure, manufacturing, agrochemical, consumer business, education, etc. Jimit has been a regular speaker on various domestic and international tax conferences. He has been regular contributor to various articles, magazines, journals, and newspapers. Jimit is also one of the authors of the book titled EPC Contracts, Compendium on Taxation and Regulatory Issues. He has already written chapters on taxation of cross-border EPC contracts and construction PE in the book titled Compendium on International Taxation. We also have with us Mr. Madhav Kalani. Madhav is the director of indirect tax team of Deloitte Mumbai. Prior to joining Deloitte, he has worked with the other big four consulting firms. He has over 12 years of work in the indirect taxation. He has dealt extensively in the areas of GST, service tax, excise duty, customs duty, and foreign trade policy across an industry spectrum consisting of consumer, energy, oil and gas, pharma, infra, and manufacturing sector. Jimit and Madhav together will take us through the nitty-gritties of the budget in terms of direct and indirect taxation. So we also have with us our own senior leadership of our member companies. We have with us Mr. V. Vivekanand, Vice President ICMA and Director Caterpillar India Private Limited. Mr. S. Jagannathan, CFO and Company Secretary Schwegstatter India Private Limited. Mr. K. Somasandan, CFO Tata Hitachi Construction Machinery Company Private Limited. The industry leaders will give us the CE industry's views on the budget and will also ask relevant questions to the experts. I now request Mr. Ashish Modani from ICRA to take us through his thoughts on the budget. Yeah, over to you, Ashish.
Thank you, Mr. Bakshi. I'm audible, right?
Yeah.
Yeah. Good evening, everyone. The union budget has provided a much larger than expected boost to the growth, including its capital spending, while maintaining a fair degree of fiscal consolidation. While we are looking around, many developed economies are going into a recessionary phase. India is emerging as a bright spot. In this, going forward, what I was discussing, let's when you're talking about FY24, I will stop talking about FY23 first. So when you look at the revised estimates in the current year, to meet the government to meet the full year target of 7.3 lakh crore for as per FY23, in the remaining 3 months, it is January, February, and March of 2023, the government has to average on an average spend around 79,000 crore on a monthly basis to meet the full year target. And so what we are seeing here is it's not the a one-off thing. It's like for the next 1.5 2 years are likely to be an exceptional year for the players in the infrastructure domain, and which is also indirectly going to be a big demand booster for construction equipment manufacturer. So when you talk about in the current year, that is Q4 FY 2023, the overall year-on-year capex will be somewhere around 18.4% up on a YOY basis. However, one we need to understand here is this also includes the special assistance to state for capital investment, the kind of assistance provided by the central government. So while the government has announced around 1 lakh crore support, 77% of that has been sanctioned, and out of which the overall capital transfer standard stands at around 49,000 crore as of now, and there is a considerable around 37,000 crore which is yet to be dispersed or incurred in Q4. So that remains a very important number, and if that is if the states are able to meet those targets, then we are talking about 22% or 23% year-on-year target in the overall capex. I'm talking this is FY23 itself. Now when we're talking about FY24, so like if you have seen all the headline number, there is a steep hike of 37%, and the number that everybody is talking about 10 lakh crore or 10 trillion rupees. Now, this is in contrast to 7.3 trillion. It was even when we were estimating earlier, we were talking about 8.5 to 9 trillion or 8.5 to 9 lakh crore kind of capex outlay. But 10 lakh crore is something which is beyond our own expectation. And what we are seeing here is not uh, the number game. What we are seeing here is the quality of capex that is going up. So if you look at the ICRA's belief that if the budgeted level of capex materializing in 2024, it will have a multiplier impact on the support in the pace of GDP growth. If this capex of 10 trillion translate to around 3.3% of GDP in 24, which is up from 2.7% of GDP in 2023, and it is almost twice the level of 2022. So we are seeing a very, very sharp and steep growth in the last few years, and all the key drivers are largely in place. Now, what I'm telling here is it's not only about the spending, it's about the quality of spending is also increasing substantially. And with the rise in share of capex in the total expenditure, the share of capex in the total expenditure is now 22% in FY24, vis-a-vis 17% in FY23, as per revised estimate. So there is a sharp increase. So when you do capex or when you do expense, it can be for the capex, it can be for the revenue expenditure. But as your capex, if you're making more investment towards capex, it will have a multiplier impact on the all other parameters, and that is what we are seeing in the big booster in the next 1.5 year. And if you include grants in as a part of capital assets, the expansion in effective capital investment is expected to rise by 30% to 13.5 trillion rupees or 13.5 lakh crore rupees in FY24. So this is a huge number. Now, when we are looking at the key segment which are driving this, roads and railways are amongst the major one. If you're talking about the roads itself, the increase of 2.7 lakh crore in the capex in FY24 related to FY23 is steps from around 80,000 crore or almost 0.8 trillion rupees in railways, around 0.5 trillion in roads, and then there is another 0.5 trillion upside provided by the state government support the state, central government support the state entities. And what we are seeing over here is, see, when we look at the headline number, again, one thing we need to decode here is one is the direct support and one is the IEBR, which is the entities borrowing on their own books and then supporting the capex. The headline number railway may look slightly on the sharper side, but if you look at the overall capex outlay, it is only 6% up in the railways. And when you look toward NHAI, government has already revised their number for NHAI in the current year. If you look at the revised estimates vis-a-vis the budgetary estimate for FY23, they're already up by almost 20,000 crore. And now with this budgetary estimates of 24 is now increasing it further by 15%. So total capital outlay in roads and highways is expected to be up by 25% if we compare with the revised estimates in FY24. Now, generally, when people talk about infrastructure, they link or they limit their talks to roads and railway. But one another, or to a certain extent, people talk about the housing or Pradhan Mantri Awas Yojana or Pradhan Mantri Gramin Sadak Yojana. But one specific segment that we are seeing a lot of traction in the last 2 years is the Jal Jeevan Mission, the investment that is happening in the water and also towards sanitation, towards sewage, Swachh Bharat Mission also. So budgetary allocation for Jal Jeevan Mission is now increased to 70,000 crore from 55,000 crore, and that is a huge number. If you're talking about Swachh Bharat Mission, the number stands at around 122 billion rupees as compared to 70 billion rupees. So we are witnessing massive jump in various other segments as compared to the traditional segment that we talk about, the roads and railways. Now, what this translate to the players. So when you talk about the entire ecosystem, when you provide, if you look at the order books of all the players in the EPC industry, generally that is something what we gradually or regularly track. The industry is witnessing a very strong growth in the last, even despite a temporary setback that we have seen in the Q1 FY21 due to COVID related restriction. The industry has bounced back handsomely, and what has we have seen is the 15-20% growth has been maintained in the last 2 years despite the COVID related setback, and the momentum is expected to continue. If we talk about the order book for the most of the industry players that we generally track is somewhere upwards of 3 times order book to revenue visibility. Now, what that translates that there is enough revenue visibility all these players will have, and if they have to ramp up, then they really need to put investments in machineries, mobilization of the resources. Our early indicators also indicates that the yields which are there when you talk about the construction equipment rental yields, they are also moving upwards, which actually indicates that the demand is relatively okay. And while I understand that some of these yields are also going up because of the input cost pressure, but what we have seen in the recent time is the capacity utilization of these units or these machineries has also improved. So all these augurs really well for the industry participant, and what we are expecting is for the calendar year basis is one of the best year for the construction equipment industry. While I understand there are certain bottlenecks for the industry has witnessed input cost pressure. They have witnessed the cost escalation because of these changes in emission norms in the last 12 to 18 months. But the most of the price hike has largely been passed through, and what we are seeing is this one of the best ever year for the industry in CY23. As like any year in CY24, what we currently expect is whenever there is an election year, the ordering activity or the execution activity also taper down to a certain extent. So there could be a certain impact of cyclicality in this industry, which always remains a risk for these players. But CY23 is likely to be one of the exceptional year, and CY24 may moderate from CY23 level. But in terms of from the budgetary perspective, what we are seeing is the budget has provided all the right ingredients for the sector to perform exceptionally well. There has been talk regarding if the government should go for fiscal consolidation, will there be any impact on the capex? The answer doesn't look like that there could be any impact on the execution side. The execution remains extremely strong, and our channel check suggests that the most of the industry participants are mobilizing their resources, and we are expected to see some of the best quarters in terms of execution pace in the next 9 to 12 months. Over to you, Mr. Bakshi.
Thank you, Ashish, for this wonderful, well-rounded update and interpretation of the budget for us. Gives a lot of hope and confidence to the industry. I'm sure we will have a lot of questions. However, we will wait for the next session on taxation to finish when we come back to you. So now I will request the experts from Deloitte to kindly share their analysis of the budget and the implication on taxation, both direct and indirect. So over to you, Jimit and Madhav. Yeah, Jimit. Yeah, Madhav, Jimit, I saw Jimit, he was here.
Yeah, he is sharing. I mean, they're just taking a couple of minutes to share it.
Sure.
Monica, my line is
Someone
gone
see
away.
the
I don't know,
screen?
am I audible?
Yes, 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 please.
So do I need to start? Can I start?
Yes, thank you.
And Monica, the screen is also visible, right? Jimit, you can see the screen, right?
Yeah.
Right,
Yeah.
uh,
Sorry,
Okay.
some issues. So if you can go to the next slide.
Second, just a second.
Yeah. So just the good part or the good news I would say this year is there has been no increase in any rate of tax. So all these slabs, which are different rates of tax, you will see in that slide, remains the same as it is. So there is no increase. The expectation was that the manufacturing sunset clause, which was ending on 31st March 2024, will extend, but that has not been done. Let's see whether it gets extended or not. But the intention looks like the government wants that huge amount of manufacturing plants should be set up this year, and that is why they are not extending it purposefully. There is another clause which was a surprise that the funding by which if the foreign funding used to come in India, then the rate of tax was only 5% for foreign currency. That the sunset is on 30th of June 2023. That has not been extended further. So maybe the industry was expecting that to be extended, but that's not extended. Going to the next slide. This is 194 RN section 28. Basically, there was an amendment basically last year on 194 R. Section 28 has always been a statute since years. Basically, it says that any value of benefit or perquisites which you receive in the course of business or profession should be taxed in that individual's hand. So let's assume that you are attending a conference and you get mobile phone worth 60,000 rupees free. Then ideally you are supposed to disclose this 60,000 in your return of income and pay tax on it, and that is why this becomes taxable as per this section. And of course, the last year the 194R was introduced that the payer will have to withhold the tax, because that will help trace because the recipient was not coming forward and declaring this income himself or herself, and that is why this provision was brought in. Now what has happened is, because of this provision, there was another thing which was there is that let's take there is a write-off. You have acquired a particular company and say that was a distressed company, and you go to the bank and say that, oh, I want to restructure the loans, and say the loan which was pending was 1,000 crores. Instead of that, you agree for a restructuring of 400 crores. So now basically the company which is there has to make a payment of only 400 crore instead of 600 crore. So indirectly, that's a benefit to the company. So logically, as per the section, then banks are supposed to withhold tax on that 600 crore. But there was a circular which was issued that banks will not be subject to 194R. But the most important question is, if you read that circular, is that the government acknowledges the fact that this 600 crore in my example is actually an income. And now, if there is this transaction other than a bank, so if it's between a holding and a subsidiary, or between two third parties, which is genuine write back of liabilities or anything, then you need to take care of it, because then all such situations like waiver of loan or such situations, there could potentially be this impact of section 28, which will come into picture. One important point to notice now, and it's a consequential point while it's coming behind, but on 194R last year, it was not included under penalty and prosecution provisions. Now this year it will be included in penalty prosecution. So if you do not deduct tax under 194R, then even penalty and prosecution will be levied for non-deduction of tax. If you go to the next slide, the next payment is actually the payment to MSME. On the MSME, basically, you're supposed to make a payment within 45 days. Earlier also, the provision, the statute remains as it is. The only thing is, earlier, if you delayed the payment, you had to pay interest on MSME. That though is there, but now to incentivize that the payment should be made to MSME within the time limit, the government has said that if you delay the payment, then you will be allowed the payment only in the year in which you actually make the payment. So if mainly for April to February, even if there is a delay, as long as you pay within March, it shouldn't be an issue for deduction purpose. But if there is a Feb-March payment which comes up, which you delay it and pay it in the next year after the period of your contract which is mentioned, or after a period of 45 days, then the same will be allowed in the year in which you actually make the payment. And we have given certain examples that, let's take a first scenario where the agreement is entered and the agreement is more than 45 days. Then in which case it will be restricted to MSME Act, which is 45 days. And say date of the invoice is 10th of March and you make the payment on 20th of April, which is within the 45 days, you will still get the deduction of in 23-24 and not 24-25 because it is within the period which is mentioned and your agreement is also more than 45 days. But at the same time, if your agreement is 30 days and if you pay after 30 days but within 45 days, in that case, your agreement date will be final, and that is why you will not get this deduction in 23-24 but 24-25. Next. Another provision which was brought in is by for is there is this section 56(7)(b) which simply says that if today you are any company which is issuing shares to any person at a premium, then it has to be at fair market value. If it exceeds fair market value, and the provision was there that if it is exceeds fair market value and if it is issued to resident, then the company which is issuing the shares would be taxable. Now they have extended this provision even to non-residents, where it says that if the company is issuing a share to non-resident and if it exceeds the fair market value, then in those cases also the company which is issuing the shares will have to pay the tax. Now, of course, there's a dichotomy between what is there under the Income Tax Act and what is there under FEMA, because FEMA says you need to issue the shares at minimum at fair market value. That's the minimum price. And income tax says you need to issue exactly at fair market value. If you bring more, then the Indian company will have to pay tax. So this will of course impact all those companies issuing shares at a premium, and they need to check that the valuation is appropriate. Of course, this will impact the startups as well because they sometimes bring money at a very huge valuation. So let's see, hope there will be an alignment by the time bill is getting passed. Next. Another amendment was by way of InvIT and REIT. Here what has happened is basically typically how the structure works is then in an InvIT and REIT there are SPVs which are there. Now what happens is that normally it's a pass-through. So any interest or dividend received by an InvIT or REIT from an SPV will be passed through to the unit holders and basically will not be taxed unless there is a or will be taxed unless there is an exemption. So like interest and dividend, there was exemption. Then what had happened is, let's take a scenario where SPV repays the loan to InvIT. As per the InvIT provisions, 90% of the same has to be repatriated back to the unit holders. So even InvIT will be repatriating this money back to the unit holders, 90% of the same. The question arises is whether this will be treated as capital gains because technically there is no redemption of unit, whether it will be dividend because it's like a repayment of a capital return on capital, or it will be a capital receipt not chargeable to tax. And the industry was taking a position that it is capital receipt not chargeable to tax. And that is why neither at an InvIT level, neither at a unit holders level, the money was getting taxed. And that is why the government amended the law that we will tax this at a unit holder level. So maybe at InvIT, when withholding, if the withholding tax provisions are applicable, we'll have to withhold tax when they're making the payment to unit holders. So that's an amendment which has been brought in. Next. Then there are small amendments on cost of acquisition on intangible assets. There was an amendment already made to override the case of B.C. Srinivasa Shetty vis-a-vis goodwill. So many of them have started using that if it's in other than goodwill, a self-generated intangible assets, then it is not taxable as per the provisions of law, and saying that the value of that is nil and cost is not determinable. It's not even zero. Practically, you cannot ascertain the cost. Now they have amended the law that even other than goodwill, if it is any other intangible assets also, we will treat the cost as zero. So that means capital gains provision gets implicable and appropriate capital gains tax will have to be paid. Then there are some amendments in the presumptive taxation team where the limits have been enhanced. For eligible business under 44 AD, it has been increased from 2 crore to 3 crore. And for professionals, it's increased from 50 lakh to 75 lakhs. Of course, there is a catch or a condition that maximum 5% can be by way of cash. Otherwise, you cannot do it. And there has been some amendment in the 44D for foreign company power projects or oil and gas projects where it has been rationalized. Next. Then, of course, there is a now tax gain on capital gains on market-linked debentures. It will be treated as short-term capital gains instead of long-term capital gains. So there is an increase in the rate of tax, and of course, you will not get any deduction of the STT paid. Another important amendments which were there are mainly actually for divestment and reorganization, mainly for government, where they will get the carry forward of loss. The other important amendment actually on procedural in nature was on the refund provision. That today, let's assume a scenario that there was a 143(1) issued. There was a demand created, for example, because of non-grant of TDS or anything. And say by the time 154 gets passed, a 143(2) notice is issued, that is for scrutiny. Now, the government or the department will have a power to adjust that demand against the refunds which are due to the SSE after passing an order. Practically today also that's what's being done, but without any explicit power. Now they have the power to adjust that refund against the demand and then pass an appropriate order. If you feel the order is adverse, you can of course file a writ against the same. Next. Then there is another thing is TDS income on disclose. So what happens is, let's assume a scenario that on 31st March, you raise the invoice. By the time the other party receives the invoice and books, it becomes next year. So that party deducts the TDS in the next year. So practically it appears in the 26 years of next year. So, when you used to file the return, you were not getting the credit. And basically because tax department always used to go by 26 years. Now they've made a provision that, okay, if that happens, you can make an application to AO and change your credit from the next year to this year so that your income and TDS is in the same year. So that's a good amendment, a welcome amendment which has been passed. Apart from them, there has been increase in the TCS rates for LRS and foreign tours, which they have made this year. Basically, you will of course get the credit, but the government wants to intention is to also create a trail and maybe also act as an collection mechanism, because government saw that there were huge amount of foreign remittances made under LRS, by which huge amount of house property was acquired outside. So they wanted to indirectly say that we are collecting tax on those. Next. Basically some amendment in IFC and basically some extension, because till 23 it was extended till 25. And because the investments in FSC is not yet picked up as expected. So that is why they've extended the deadlines. For startups, there was a provision already there. It's not a new provision for carry forward of losses, where you can get a carry forward losses for 7 years. Now they've extended to 10 years. And the benefits of startup has been extended by 1 more year. Next. Transfer pricing, basically it's nothing more significant. As we discussed under 56, there is a change in law. Now issue of shares at a premium, if it's from related party, that also needs to be disclosed at transfer pricing. Earlier, there was a Bombay High Court decision on the basis of many of them were not reporting or not documenting it or not doing any arm's length mechanism. Now they will have to do it. Another thing is that there was a time limit for 30 days for submitting the documentation to the department once asked for. Now they have reduced that to 10 days. So you need to be geared up for preparing transfer pricing documentation in advance. Next. And there were certain more of procedural aspects, mainly relating to search and seizure, where if there are certain search and seizures, the timelines have been extended. For the paucity of time, we are not going into detail. The next provision is only on, as I said, penalty and prosecution for not withholding of tax, either under 194R or for cryptocurrency or for online gaming. And they are going to set up a new commissioner, JCIT, Commissioner of Income Tax Appeals for small matters. Now, what do you mean by small matters will be issued and notification will be issued soon. Next. Then there is small increase in the penalty amounts for SFT if you do not liberalize. All other provisions are mainly for search and seizure. Only one thing is they've decriminalized the liquidator, because under IBC, no liquidator was ready to become a liquidator because they were also being prosecuted. Now they've brought in a law that, okay, liquidator, you have done nothing wrong, so we will not prosecute you. And that is why that has been decriminalized. Next. So maybe over to you, Madhav, for the indirect taxes.
Yes, thanks, Jimit. So I'll start with the indirect tax amendments, which includes changes in GST Act as well as the customs. Now, as you all know, if we look at GST, majority changes are generally being announced in the council meetings. Only certain things which needs to go through legislative changes come in the finance bill, and likewise certain announcements made by the GST Council over the past period are now being enabled in the through the GST amendments. The first critical changes which has been made is in respect of the input tax credit availability in the hands of the companies or the assessees. So any CSR expenditure being incurred by any person, the ITC of the GST paid on such expenses will be expressly disallowed. Now, this whole issue has been litigated by many companies, and there have been favorable decisions by the advanced ruling authorities that CSR expenditure is a business expenditure and should be allowed. Now, putting a rest to that litigation, they have expressly disallowed it. So it effectively means that it will increase the cost of CSR expenditure in the hands of the company. In respect of one more change is that if there is any bonded sale, so many companies purchase goods imported and they store it in bonded warehouses. Now, those bonded warehouse, if there is a sale taking place, those sales are out of GST net, so there is no GST on the same. But what is being done is that any expenses incurred for those sales or the GST paid on such expenses will be expressly disallowed, or it will have to be reversed. So these are the changes in respect of ITC. There is another provision which is introduced and which is a very interesting one, is that they will follow consent-based sharing of information. So person filing details of GST on the GSTN portal, the GSTN will take a consent of that person to share that information with governmental tax and non-tax authorities. This means that while things were still being done, but now they have formalized a process to share that information with other departments. Now, this will increasingly mean that what is being submitted to GST will now be in hands with many authorities and will be under scrutiny. So this is again something which is an enabling provision has been brought in the law. In respect of certain transactions such as high C sale and other bond-to-bond sale, it has been clarified that there is no tax on those transactions from 2017 July onwards, because there was an amendment which came in 2019, expressly saying that these transactions are out of GST net. Department was asking tax from 2017 to 2019 intermittent period. Now again that has been put to rest, and again it's a welcome clarification which has come through an amendment that no such transactions will be taxed. But the flip side of it is that any companies who have paid tax on such transactions will not be refunded back the tax which has been paid. Again, an area to explore whether the tax which is being paid can be asked as a refund, because again it will be distinguishing between two taxpayers, which is against the constitutional principles. So this is an interesting change which has come. In respect of, there are certain operational changes which have come in the GST law. One is the time limit for filing the returns have been fixed. So you have, I mean, a person can file a return under GST, GSTR1, which is outward supply return, 3B, which is my tax returns, and 8 and 9 and 9C, which are the annual returns, from the due date till only 3 years. So there is a time limit, there's an outer limit prescribed to these returns. There cannot be a return filing post this period. So effectively meaning that if the companies are not able to file the returns, maybe the ITC of the recipients will still be a disputed one. So there can be a challenge on that perspective. There have been alignment of the GST reversals on account of non-payment to the vendors within 180 days because of the return. There's again a change which says that the section amends to say that the payment should be made to the supplier. Now, many times what happens that there are payments which are being recovered by government authorities under the insolvency proceedings by some other person on behalf of the person. So whether the payment will be considered as an effective payment or not, again, that's something which needs to be seen to allow the credit in the hands of the person who is actually paying those amounts. Then again, the whole point is in respect of GST registration. So any person who is exclusively dealing in exempt supplies of goods and services, maybe some company foundations, maybe some diagnostic centers and all, they were all dealing in exempted goods and services. But they were still required to take registration under the GST law to discharge the tax under reverse charge mechanism, which was always a cost for those companies. Now, what has come is that there's a change in section 23, which allows that in case if a person is only dealing in exempted goods and services, they need not take registration, even if there's an RCM liability. So again, it's a beneficial provision because it basically will not have a cost impact on the companies or persons dealing in exempt goods and services, because there's no tax payment which will be required to be done on the RCM services such as legal fees or transportation or the GTA services. Again, a trade measure by the GST Act, certain offenses have been decriminalized. That means the prosecution cannot be initiated in case of those lapses, such as there's an obstruction or prevention of an officer in discharge of his duties, tampering with material evidence or documents, and failure to supply information or false information under the law. This means that while prosecution is still there in the GST law, certain offenses have been kept out of prosecution. Also, in respect of prosecution in certain cases, the monetary limit has been increased from 1 crore to 2 crores. Only in cases of false invoices or bogus ITC claims, this limit will not be applicable. So the revised limit will not be applicable. Also, provisions for compounding of offenses under the GST law has also been a little bit eased out. There's a reduction in the composition fees, and other offenses have been brought into that net so that the compounding also can be brought in place. I'll not go to OIDR services because it may not impact the industry as such. So there has been a exponentially increase in the scope of OIDR services, which is online information and database access services, by a change in the Act. In terms of amendment in customs, various changes have been proposed in customs. Now, the idea of the government from last 3-4 years have been a constant push to domestic manufacturing, also to promote exports and phase out exemptions gradually. So that has been the motive, and we have seen in many cases like electronic equipment manufacturing, be it vehicle manufacturing. So what they have done over the period is that they have reduced the customs duty on the components or the parts of it, or the raw materials for these products, even for consumer goods. And at the same time, they have basically penalized the import as such, or the whole equipment as such, so increasing the customs duty. So this has been the theme, and the theme continues. Also, there have been some sunset clauses which were put on certain exemption notifications. So in 2021 budget, time limit of 2 years was prescribed for certain exemptions which are given in the Customs Act, which is expiring in 31st March 23. So those exemptions will phase out. However, there have been a extension of certain exemptions beyond 2023 also. And there has been a change in the law which prescribes that if the exemption is on account of any trade agreements, or if it exemption is account of any foreign trade policy, those exemptions will not phase out. That means there is no sunset clause applicable to those benefits which the companies are claiming. Also, the time limit for disposal of application of settlement commission has been prescribed. They need to pass the order within 9 months. There have been some changes in the Customs Tariff Act. Customs tariff define the rates of duties applicable on a particular product and how do you classify a particular product. So that has again constantly been aligned to the HSN 2022 published by WTO. So there are certain procedural changes which again will be depending on how do we basically which product we are looking at and where do we are looking at. In terms of exemptions, as I said, out of 195 exemptions, 146 exemptions have been extended for 1 more year, which was supposed to get expired in 31st March 2023. Again, for some others, there have been extension of 5 years, 2 years, and 1 year. So again, while the phasing out is clear, but there is for some products that the phasing out is a little bit slower and they have been extended. For certain products, again, as I said, there has been an increase in the customs duty rate in terms of the overall policy framework of the government. If we talk about vehicles, any import of vehicles in semi-knockdown form, the custom duty has been increased from 30% to 35%. If it's a completely built unit, the custom duty is increased from 60% to 70%. Even for EVs, even in CVU forms, the 60% to 70%, there's an increase in the custom duty rate. At the same time, the equipments and the plant and machinery for manufacturing of the cells, the customs duty exemption still continues. So to incentivize the production of EV cells for the purpose of EV manufacturing. And again, certain chemicals and other products, the rate changes have been there. Also, in respect of coal, there has been a change in the rate of tax. So in nutshell, these have been the changes in customs duty rates, which basically may impact, and obviously the likelihood impact of all the companies or maybe specifics needs to be seen on a case-to-case basis. But there have been a lot of changes in the duty rate structures in nutshell. So I think. Again, I'll not cover this because it may not be relevant. So that's it from tax perspective. Maybe any questions to me and Jimit, happy to answer those.
Yeah, thank you, Jimit and Madhav, for this very detailed and very useful presentation on direct and indirect taxation. If you know, I'm sure this will benefit the finance and business teams for our member companies. You know, there would be a lot of questions, frankly, because this is a technical subject. But I'll hold the questions for some time as we go to our industry leaders. You know, we will start with Vivek. Vivek,
Yes.
I think you joined.
Yes,
Hi,
yes.
Vivek. Yeah, Vivek, maybe, you know, we can start by asking you, you know, as an industry, we have embarked on a journey to make this industry about $25 billion by 2030. Do you think that budget 23 is a step in the right direction? And in case you can answer, you know, what are your two key takeaways from this budget, Vivek?
Yeah. Thanks, Jesse. Hope I am audible.
Yes, Vivek.
Yeah. Sorry, I had some trouble joining, but again, thanks for Jesse for the question. And I think overall, if you were to really just ask from an ICMA standpoint, we are still bullish on the Vision 2030 plan, meaning to say that we are well on the trajectory to really just get to that aspirational goal. And one of the primary reasons why I believe that we have the belief is to really just see the continued thrust on the infrastructure, because definitely there is a significant increased enhancement of the budget for the infrastructure building, close to 30%. And that's definitely going to translate into a significant demand for the construction equipments. And also there is a significant amount of activities which is happening, which will eventually translate to enhanced demand for the metals and non-metals, which will eventually also be the primary driver for demand for the equipment. So to answer to your question, Jesse, definitely this budget is definitely a step in the right direction to really just get us back on trajectory to realize the vision. And having said that, I think if you were to really just talk about the two key takeaways, I think this year we know that it's actually a pre-election year. And there is a natural tendency of the government to really just get into the populist measure. But I think this government has really just stood steadfast on actually being progressive. And then they really wanted to focus on growth. And growth obviously has infrastructure as a backbone. And I think this budget was no different than the previous budget. I think the government is very clear about the thrust they need to give on the growth. I think that's definitely one key takeaway. That means there is a good amount of sustainability which we could expect in the growth focus of the government, which means it's not just about what will happen to the growth for the next 1 year, but also for the subsequent years, which would eventually is what we want, because we do want to have a 12 to 15% CAGR to really realize our vision. And I think this budget is definitely a step in the right direction, not just for the current year, but also to reinforce the confidence in the industry that this is actually just going to sustain for the subsequent budget and thereon. So definitely, I think number one thing is government not getting distracted because of the election, and then staying on course for all the things on infrastructure building. So that's number one. And the number two thing is, if you were to really look at what was the reason why the demand in the first 2 quarters of the financial year was really dull, is largely because of the other factors when it comes to the funding, or as well as some of the infrastructure projects didn't really progress. But in the last quarter, we have definitely seen a significant amount of uptick. And I think that's also a good indication of how the government is really wanting to channelize the funding and then remove some of the roadblocks, and also get to the point of actually resolving some of the issues which can potentially help us to make progress. And I think this budget, by virtue of sheer allocation of the money, it's definitely good, but it's more than the allocation of the money. Even if in the first 2 quarters, we saw that the the green spots were predominantly in railways. And if you were to really look at the quantum of allocation for railways, be it MRTS or your high-speed rail or anything else, and I think there is a significant amount of budget. And the railways will have the least of the disruptions than the road projects. And I think that's also a good thing, because whatever the green shoots which we saw even in the first 2 quarters, which is largely driven by the railways, and I think that's something which we can continue to expect to happen in the whole year. I mean, the next financial year. And on top of it, we already see the spurt in the demand happening on the construction side of it, and we hope that it will sustain. So I think definitely these are 2 important aspects which we as an industry need to be really just upbeat about to ensure that we stay on course to realize our vision.
Sure, Vivek, thank you for this. See, while we are on this, there were 2 demands, which industry has been doing for last many years. For example, as a finance industry or CE finance industry, we have been asking for a PSL status for construction equipment, because we basically add to the infrastructure. This industry add to the infrastructure development of the country. So which is still to be met. And another important thing, which you are driving, Vivek, is PLI for our OEMs and the component manufacturers. So, you may take this opportunity to maybe apprise the members of where we are on this, and, is there any hope for PLI for this sector, Vivek?
I think thanks, Jesse, for that. And I think there's been an extensive amount of work done by the manufacturing and supply chain panel on this front. And I would say that definitely there is a significant amount of positive progress which has been made. That means all the stakeholders are in perfect alignment, that they strongly believe that infrastructure is the backbone of the country, and then ICMA as an industry is going to be a key enabler for the infrastructure building. In that context, I think while all sectors are fighting for their share of PLI, they are fairly clear that ICMA definitely deserves the most. Having said that, I think we are currently having some work which is under progress to actually just lay down the contours of what that PLI program for the construction industry is going to look like. And we are probably on the last leg. Of course, it's job not done, but we are pretty confident that the manufacturing and supply chain panel, which is led by Pratik and Suresh Nair, are pretty much close to getting it to the finish line, and which is going to really give the biggest of the fillip to the industry in terms of building the capacity, what we want. Because we do have a residual capacity, but if you were to really look at the future demand, which is going to grow from the $7 billion to $25 billion, and I'm sure we all need to have capacity. And on top of it, one of the important aspects of PLI is to actually just embed that Atmanirbhar Bharat, by virtue of which we actually just get to localize a lot. One is in the context of equipments, what we currently import, and other is in the context of the components, what we use for the equipments which are currently imported. And we are really just aspiring to accomplish that Atmanirbhar Bharat through Make in India initiatives if the PLI is made available to the sector. So I think we will definitely get there, is my view.
Sure. Thank you, Vivek. So I'll move the spotlight to Mr. Somaskandan. So you're there.
Yeah, am I audible?
Yeah. Yes. So Somaji, Tata Hitachi is, one of the largest OEMs, who's into manufacturing excavators and selling excavators. And you are present in almost the whole range of customers, starting from rural to roads and mining segments. What do you think that budget has for these 3 segments particular?
Oh, thanks for the question, Mr. Bakshi. So I probably will talk about mining separately, because we don't have anything as a provision in the budget. That's what we were going through along with our team. Probably it may be
Sure.
maybe dependent on the capex of respective government companies. For instance, Coal India, what is the kind of capex that they will bring in the subsequent years? We definitely read very recently that Coal India has been very gung-ho on the infrastructure, on the investments on the mining. So as an industry, we will get to see mining excavators going from maybe around 4% to a bigger share of business, as we see in the next 2 years. So that's as far as mining, as far as not seen in the budget provisions. But otherwise, if you see the rural and the infra, I think 2-3 areas where Ashish also had mentioned in the beginning about the total the budget allocation on the water resources jumping from say around 58,000 to around 74,000. The Pradhan Mantri Awas Yojana, as well as the Pradhan Mantri Krishi Sinchai Yojana, going from say 8,000 to 11,000 and about 77,000 to 79,000 respectively. These are all the probably the opportunities for the industry players to look at more and more numbers as far as the infra as well as the rural sectors. And rural development also, I think the position currently what we see is in all these areas, the construction equipment industry can have a decent share of around 12 to 13%, which will probably will be in a better position to grow over a future period. But around 12 to 13% is what we see as a play in these areas currently, which is a good sign compared to the earlier quarters, as mentioned by Mr. Vivek as well. We are seeing the traction growing in the last quarter, and we are quite hopeful that the numbers will be much more decent as we end the year 22-23.
Sure. Sure. Somaji, see, while many of our projects are driven by the central government, as we know, but states also play a very major role in some of the sectors, like as you said about Jal Jeevan Mission. That's also mix between central government funding and state government funding. Similarly, roads also, there are some state roads, etc. So states also play a major role in infrastructure development. So, what do you think, are the states, financially well placed to support this initiative? And, are they funded enough, or is there something in the budget which is helping them in terms of fulfilling, what we are talking about today?
I think there will be two ways for the states to deal with this. One will be the direct allocation that the center, do as a practice. If a pie is say 100 rupees, I think 60% of that will come from central, and the 40% will have to be shared by taken on the table by the state government. While there will be processes on getting that 60% on board, other 40% is what probably the state governments will have to dwell on their own captive corporation. For instance, if you have to talk about power finance or infra development, I think the state government will have their own power finance and infra corporation where the public fixed deposits are accepted as per the RBI norms. There has been, I think, with the help of state government backing, there is no shortage of funds, is what we infer, and this will help them in their infrastructure development path. So I don't think there will be any major impediments for the state government to raise finances. So they have options and very well probably entrenched to get this work done in the future. That's what my reading is.
Sure. Thank you so much. So we will now move to Mr. Jagannathan from Schwingstatter. So you're there?
I'm there, but sorry, Mr. Bashi, that I'm not quite, prepared for this meeting. So only representation from my side is that, we need to push on this PLI. We have been talking about it for quite a number of time now. I think that helps us, the industry, in a bigger way if we are, getting into the PLI part of it.
Sure, Jaganji. So I also take this opportunity to prompt our senior leaders here in case they have any question for our experts. While we'll come to further questions from our side as well as from the audience side. In case Vivek, Somaji, or Jaganji, if you have any questions for Ashish, Jimit, or Madhav, you can please go ahead.
No, it's not a question. It's just an observation that we also had. If at all, there would be any major impact on the material cost front for the construction equipment industry. Looking at the changes in the, looking at the changes in the customs or any other GST front, I don't think there will be major changes as far as the taxation structure is concerned. So it's just an observation from my side.
Sure. Sure. So I have one question for Ashish. So Ashish, see, the government has chosen the path of relative fiscal prudence. There is a projection that they'll decline the fiscal deficit to 5.9% compared to say 6.4% if the figures are right. The government had further plans to continue on this path and reach a fiscal deficit below 4.5% by 25-26. However, on the other hand, the government has announced a 33% increase in the capex allocation for FY24. So do you think the government will be able to balance its finances, to meet both the targets? Do you expect any shortfall in the infrastructure spending going forward, or how it can impact our industry? Yeah, Ashish.
Yes, sir. So if you look at the next year, if you talk about the government's own tax collection growth estimates also, or the overall revenue growth estimates also, they look pretty rational. And and despite that, what they are building is 10 lakh crore kind of capex that is already been built in. So what we see is that given we are in a year prior to election, and there will be a strong push, and what I told earlier also is that the overall mix or overall like earlier, instead of revenue expenditure, now you're talking about capital expenditure, which is again going to be a growth multiplier, job providers also. So it is in interest for the government also to push, continue to provide that kind of push, and that's what we feel. And our interaction with multiple stakeholders across the value chain, be it the construction entities, be it the authorities, I think everybody is very optimistic regarding the next. Especially regarding the current calendar year, to talk about CY23, the execution is likely to remain very handsome in the current calendar year. So we don't foresee any kind of slippage in execution, at least in the current year. Again, when country goes into election phase in the 6 months, or there could be slight moderation next year, but it will be a temporary thing, just like in every election time we have seen. Subsequently, it will even out, and then we should be again on the growth phase after that point of time.
Sure. Thank you, Ashish. See, one question, that comes to me for both Jimit and Madhav. Maybe they can, answer one by one or together. See, government has been pursuing its path of ease of doing business, and we just heard Jimit and Madhav talk about various provisions of both direct and indirect taxation. So if you have to maybe summarize, so does it, does the whole thing, or the budget 23 helps with the this particular mission of the government to bring in ease doing business, or it makes, or it's the other way around? So just wanted your views, maybe Jimit and Madhav.
So one point as far as ease of doing business, if you look at it, what this government is actually trying to do is trying to bring stability to the tax law. So it's not making amendments year on year, which is a very important aspect, because any business would require a stability, to predict their outcomes and everything, which this government, to the extent possible, they are not making any retrospective amendments as well. So that also brings good amount of stability and certainty. So from that perspective, it is good that they are doing ease of doing business. Yes, government can, while on compliance bit, they can still do a bit, so that helps in ease of doing business, because still there are a lot of compliances which are yet to be streamlined. But I think so it's moving in the right direction, if you ask me, Mr. Jaswant. Yeah.
Sure. Yeah, Madhav.
To second it, yes, the process is definitely to achieve ease of doing business, and I mean, again, the acts reflect it in terms of phasing out exemptions and bringing out the changes in the Customs Tariff Act only, so that there's a clarity. Because what's happening today is that there are hundreds of exemption notifications in the customs, and there's a different rate in the tariff. Now what they're doing is that they're removing the exemption notification, bringing out to the tariff. This is just one part of it, which definitely eases out some of the compliances also. Also in terms of taking proactive measures to basically correct the anomalies in terms of the act and the rules and to reduce that litigation, definitely there have been steps which are taken by the government. Obviously, it will take time to reap the benefits of it, but yes, the steps have been taken in that direction.
Sure. And, both of you mentioned about decriminalization of certain offenses. I think that will also help, help in the cause, this cause.
Yes. Yes.
Yeah. And see, you also talked about InvITs, and as we see it, there'll be a lot of InvITs coming, particularly due to the model, which the HAM model basically, which is very, very popular and for both government as well as for the private, and it looks like it has hit the right chord between government and the public players, and it seems to be the right model in a PPP mode. So you think that the taxation provision what you talked about, will it hamper the InvITs going forward, or is it just a harmful? It's just as harmful as it was earlier.
No,
Harmless, sorry.
it will
was as
impact,
harmless as
no,
it
no,
was
no, it
earlier,
will
yes.
impact the investors because practically the IRR which the investors used to get in InvIT, that will certainly reduce. If you ask me just in all earnest, this was a loophole. People were making a use of it and repatriating the money tax-free. Now, they can actually, this will be taxed because see, in earlier situation, the repayment was getting tax-free in both the hands, in the InvIT as well as unit holders. So it was a very lucrative option. Now it will be taxed in the hands of unit holders, maybe rightfully so. Now, of course, the only question which will arise is, there were certain situations that it is taxed as income from other sources. Now the question arises whether income from other sources is the right way or whether it should have been taxed at capital gains because the rate of tax under both the scenario is very different. Maybe that's a debatable question, and maybe government may want to rethink on that because if they want more and more investors in InvIT, certainly government will think about it. Yes, but certainly there will be a relook from the foreign investors before investing into an InvIT because their IRR will get impacted.
Okay. Okay. So, Jimit, another question that comes to the mind of the industry is, say, given that there is a continuous technology upgradation which is happening in the sea industry, and slowly, as we see it, sea industry is becoming the global the center for global manufacturing here. A lot of people are actually making and exporting it to various parts of the world. And continuous research and development is needed. So we have been asking for, I don't know whether there is any answer in this budget, because so there was a request from the industry to reinstate that 200% reduction which was allowable earlier in the R&D expenses. So I don't think it has been addressed, but this was one of the recommendation. And any views on this?
Yeah, so frankly, if you ask them, this government is not very inclined in giving weighted benefits. They are in fact trying to see if they can lower the corporate rate tax so that it becomes simplistic rather than giving sector benefit initiatives. The reason is, they are not able to map exactly as to what exactly is the benefits which they are receiving instead of giving away this 200%. Might as well reduce the corporate rate tax so that somebody can at least benefit from that. That looks the benefit unless, so tomorrow, even if the proposal is accepted, they will link it to so stringent conditions that they would want to see that, okay, if you are really doing R&D, they will put certain stringent conditions so that you will get the benefit provided you show them certain tangible benefits. And the earlier regime that, you can just claim 200% even without demonstrating the real output benefits, where government is not able to determine whether there has been a real boost to the R&D or not, government will be less inclined to give, at least this government, they might as well say, okay, I might as well reduce the tax by 2% rather than giving the R&D benefit, so that's unlikely.
Sure. Thank you, Jimit. See, one question is for both Vivekanand and Madhav. See, because we heard Madhav talking about the custom duties for electric models, etc., and CKDs, etc. So we were in Boma last week and we saw a lot of electric models, a lot of excavators running on electricity. While it may be too early, but do you think the budget is promoting the alternate fuels, particularly say electric vehicles for CE industry, or will the recent provisions which have been added will actually slow down the whole process? While you did talk about exemption on the EV cells, etc. So maybe Vivek and Madhav, you can answer.
I would just answer from the industry standpoint. I know in the recent Boma Con Expo, we did have a good amount of display of electric vehicles. And I think as an industry, we do believe that we need to really be actually finding alternate fuels as a solution to actually just in the context of sustainability, let me put it that way. And I think we already have alternate fuels white paper as we speak. And immediate alternate fuel, what we as an industry is already embracing as we speak, is biodiesel. And of course, there is also a lot of work going on CNG and also flex fuel and as well as hydrogen fuel and also electric. I think it's not that we are very specific about one type of solution because our products, as you know, is very diversified from the smallest of the product to the largest of the product, which gets used in a mine site. And also the application is fairly complex. And we can't really think about an alternate fuel without thinking about the complete ecosystem to say so. So definitely alternate fuels is in the cards, and it may not be like this versus that or only one way to move forward. I think it could be a blend of different solutions for different product based on the applications. And that migration has already started, and that's what you got to see in the recent BomaCon Expo. And I do expect that in the upcoming XCon, which will be in the later part of the year, there will be more and more of that. And I think that's typically the way forward, and we would definitely see traction. And at this juncture, we are not really seeing a significant benefits that are actually coming out of the budget in this context. And at this juncture, even we are not very clear about what we want from the government. But as we did hear from Mr. Nitin Gadkari, who came for the inaugural session of BomaCon Expo, that he actually said that he won't incentivize usage of alternate fuel, but he will penalize usage of fossil fuel. So I think there is a lot of disincentive than incentive at this juncture, which is on the cards. And I think he keep dropping that in very often. And I think as an industry, we do recognize that we need to actually just progress in our own interest to ensure that we don't really get to affect the cost structure of all the projects.
Sure. Madhav, anything from your side? You did mention about the EV and the taxation on the EV custom duties particularly. So would you like to put some light again on this? Yeah.
Yeah, I mean, these are some of the small steps taken to basically, I mean, obviously to create an ecosystem for domestic manufacturing, to promote that, because again, it is definitely an alternative fuel, and amongst other technologies, one is definitely an EV, which basically needs to be promoted. And again, the idea is not only to basically disincentivize the fossil fuels, but also to basically promote the industry as a whole. Technology, because again, this comes with a lot of investments, and again, there's a lot of employment generation which comes out of it, and then obviously to promote India as an export hub for this particular industry as well. So it's basically a number of things being targeted with some smaller steps. And yes, the steps are in the right direction. And again, the FAME schemes and the kind of PLI scheme for the lithium battery cell manufacturing and other EV promotions. So these are all steps coordinated to achieve one goal, again, net zero or different aims. But these are, yes, I mean, these are enablers to this whole development.
Sure. So there is, one question that has come to me on WhatsApp by somebody from the industry. So Jaganji, Somaji, I'll ask you one question in case you would like to answer. See, there have been, some of the inclusions which we talked about, the good things which are happening. Do you think, something which was very important, which should have been included for us in the budget has not been included, or maybe in the next budget it should be, and we should, as an association, we should talk about it, in the next budget.
my mind, as of now, I'm not able to tell anything in particular. I think
Sure.
the good point itself is nothing has come in terms of increasing the cost aspect is probably one good thing that we should be happy about. And I think they have given all kinds of encouragement for the industry to sort of move ahead. We should see that first happening, and then probably once we sort of move from the 7.7 billion USD as we move forward, then probably we can be in a better position to place our demands more strongly. That's maybe.
Sure. Sure. So I would request Monica. Monica, can you run through the chat box, and do we have any questions from the audience?
Yeah, not right now, but I think Mr.
Okay.
Vivek Kajela is there with us, so he may be requested if he has any
Sure. So
questions.
Vivek ji, Deepak ji is also there. So in case Vivek, Deepak, you have any questions from our experts, both from the industry or the economy perspective from Ashish, or taxation perspective from Jimit and Madhav, you may kindly go ahead. Yeah, Deepak, Vivek.
Good evening, everyone. Good evening, Joshi. Good evening.
Hi, Vivek. Hi.
Good evening. Good evening. Nothing, I think very well explained. So nothing much to right now which comes to my mind, except that, while the budget is talking about a lot of capex, the only thing that I have in mind, whether it will actually, happen on the ground. So which I don't think we can really have an answer right now. And moreover, the Q4, which will go into the pre-election period, because April, May would be the central elections, and therefore whether this entire investment would continue even in the Q4 or not. So that's the small, from the construction equipment demand perspective. While this 10 lakh plus capex, it bodes very, very well, but unless we have seen in the past also that while even last year there was a significant growth in the capex in the infrastructure, but then for things to happen on the ground, we did not really, at least till Q3, we did not really see the kind of demand that we hoped will really come up for the construction equipment. So that's from the construction equipment demand perspective. That's the only doubt that I have in mind. How much will really translate into reality for us.
Sure. Maybe Ashish, you can, you did talk about, how the revised estimates are there for, and how, a little bit Q4 would look like. Maybe you can respond to this. And just to add to, his question, we also are now seeing, there is the chance of, recession, and in the UK, people are talking about it. It is there, and in other part of globe also. Do you, how you think it's going to play for India, Ashish?
To talk about the current year, basically quarter for the current year, again, what I told you is 79,000 crore per month that is required for the government to meet their revised estimate target, which is huge number. While the states will also play large play in that, but again, these numbers are huge. Now, when talking about next year, when government is planning that, I understand during the quarter four of financial year, or let's say quarter one of the next calendar year, there will be slight softness in terms of execution activity. But what we are going to see is that from this current year January to, let's say, next year January, we are going to see a strong execution pace. That momentum is expected to continue. And just on the demand side, the initial demand driver is like what generally happens is the yields and capacity utilization are the first thing. Let's say if current customers, if they are able to utilize their assets properly and get remunerative yields on this, then only it makes sense for them to start looking for new assets. So all these two indicators are showing a positive trajectory. The capacity utilization trend is on the positive side. and the yields are also going up. So basically, it makes sense for them to invest. What remains a deterrent is a increase in the interest rate. But if yields remains pretty firm, then it makes absolute sense for them to continue to invest in this capacity. And when you're talking about if they have a visibility, let's say if you don't have visibility for next 2 years or 1 year or 3 years, then it doesn't make sense. But because when you purchase it, equipment, you purchase it for 5 years, 7 years life cycle. So if you see that the government remain bullish, the infrastructure story is likely to remain in play. And what has happened in the past is people develop assets and it remain on their books. Now, when you're talking about InvIT and REIT and multiple other platforms, there are people who are ready to invest for 15 years, 20 years, and willing to take a shot on the Indian infrastructure story. So if you are able to provide this much necessary capital, which was actually missing a few years back, that is already available. I think we are on a very sweet spot. And while there are short-term headwinds can never be ruled out because we are in a cyclical industry. So 1 quarter or 2 quarters here and there will definitely happen. But if you're talking about the next 5-year horizon, we are going to see another hike. So there is no doubt regarding that. If you're talking
Great.
about
Yeah, sorry.
you're talking about the international market. I think one thing that we need to see is currently our import contents continue to remain very, very high, especially in few particular segment. So there's a lot of potential for that components to get localized and indigenized. The volumes goes up, and what we see is in the medium to longer term horizon, just like in the auto component space in the automobile industry, we see a very strong opportunities for the component vendors for the commercial construction equipment industry also maybe in the next few years. Currently, the volumes are low, so it doesn't make sense. But construction equipment is also a part of a strategy when we discuss with the construction commercial vehicle component supplier. So when they talk about their de-risking strategies, they do talk about construction equipment as one of the key segment, and that's where you can also, as a ICEMA, can also draw some synergies from the auto component players and work closely to get benefit out of it.
Sure. Yeah. Thank you, Ashish. And I think with this positive note, we will bring this discussion to a close unless there is one last question from anybody. Otherwise, we'll bring this discussion to the close. And thanks a lot. I think you have to summarize. There have been excellent discussions. Starting from the economy, starting from the what the budget provides for our industry, as well as what it means for us. Thank you, Ashish, for this, and thank you, Jimit. Thank you, Madhav, for bringing in the nitty-gritties of the taxation. Which for some it is too technical, but for the people who are into finance, who are dealing on the day-to-day basis, I think it was very, very useful. And thank you, Jimit and Madhav, for that. Thank you, Ashish. Thank you, our industry leaders. Thank you, Vivekanand. Thank you, Jagannathan ji. Thank you, Soma ji, for coming in. It was an excellent discussion. I'm sure the members have benefited by this. We will circulate the notes and the presentation, etc., with our members. And in case there are any questions, we will certainly come to you, Ashish, Madhav, and Jimit, and we'll get back to the industry if there's any unanswered question. Thank you, GC members for joining in. Thank you, Deepak, Vivek, for joining in. Thank you, ICEMA Secretariat, for organizing this wonderfully. Thank you, members, for joining in good numbers. I'm sure if I have to summarize, I think the budget is giving us an opportunity to grow, but this is also giving us some kind of a stability in terms of the way Jimit and Madhav was saying, in terms of taxation and compliance requirements, so that we move on a very, very strong footing, and we don't make mistakes which were probably made in past. And we just hope that with the kind of investments what are going to be infrastructure, construction equipment industry is going to be a major beneficiary of that. And I don't see a reason why we should not be achieving our vision for 2030, that is about $25 billion. And thanks a lot once again. Thank you. It's been a wonderful session. Thank you everybody.
Thank you.
Thanks a lot.
Thank you.
Thank you.